Welcome, everyone. Another Back and Forth with Becker and Orr, and we are ready to go talking about inflation. What will it take to bring down inflation? That topic, plus all the others on the bottom. You want to stick around.
It's summertime. It's back and forth time. We got a whole bunch of stuff to deal with for you today and a lot of topics to cover. So we will get right to it. But first, if you want to see more of our back and forth or financial 15s or anything else, please subscribe to our YouTube channel. Lots of great content there. You'll love every minute that you see of it. Or like us on Facebook. Or most importantly, please go to our website at beckerorr.com, log in, take a look at everything that's on that site. Lots of places. And you can chat with us anytime you want to. But today, we are starting off with, as you said, inflation. Clint, the question is, what will it take to bring inflation down?
That's what we're finding out right now. I mean, inflation is quite high in Canada. What are we, over 7% now in the official figure? In the US, over 8%, getting close to 9%. And the question is, what's it going to take? Now, I mean, we know the economy is going to have to slow down. We know they're going to be increasing interest rates. It's a matter of degree here. How high are rates going to go? What does that mean for the economy? Do we have to go through a recession to bring down inflation? I'm starting to lean towards we might need maybe a small recession, a slight recession. Can you have just like a tip of a recession, like just a little bit of a recession? Because I think that's what we might need in order to bring down inflation. Are you on the same page?
Yeah, I think you're exactly right. I mean, the entire time frame before this ever came up, this was all transitory inflation. It's because the pandemic shut everything down. Once we open everything up, it'll all disappear. That's not happening. This is really here. And again, what is inflation? I mean, basically, we're talking about it's too much money chasing too few goods. That's a lot of what's gone on there. So, yeah, I would say that originally we would have had that sort of soft landing where, okay, you avoid the recession sign. But I think that because of the way the heights are and because of the way the interest rate things are moving, you're right, we're going to have to hit it. I don't know that we're talking hard landing and severe, but you're right. Could this be 3 months, 6 months, 9 months? Any of that's definitely a possibility for the recession. But I don't think it's going to be as dramatic as the 1970s was.
No. They've already started moving. We've had other videos. We've talked about the 70s, and this really is not like the 70s. There's too many differences. But part of that whole issue and why I think we might see a recession now is because of the transitory debate, right? If they would have started raising rates back, end of 2020 into 2021, a whole different scenario. Instead, they're going to let things go and say, don't worry about it. It'll be transitory. Now they're behind the curve, right? Now they're raising rates at a faster clip and playing a bit of catch up. And I think that pace of the increase could increase the severity, unfortunately. So that can make it a little worse. But related topic here, we're talking inflation. What's it going to take to bring it down? That also leads to the question, how high do interest rates go?
Well, I mean, originally everybody was talking sort of that 2, maybe 2.5% is what we were originally going to see. But I mean, with the way inflation's taken off and the Fed and the Bank of Canada and actually most global governments, they want to attack this no matter what's going on. So rates will continue to move until inflation is brought into line. Now, if anybody's thinking the early 80s, no, we are not seeing double-digit interest rates. We are not getting anywhere near that. But we could easily see anywhere between 3 and 4% on the high end, I would say. My view is you're probably going to get 75 basis points in the middle of next month from Canada. You'll get another 75 from the US. We may get 50 to 75 after that. So that 2 to 3, maybe even 3.5 range is definitely possible sometime into the middle of 2023. So yeah, rates I think are going to go to that point where you're going to have a bank rate that's going to be at least close to 3%.
Yeah, so the bank rate, just to give us a comparison, Bank of Canada raises rates. Often the banks will adjust their prime. Right now, the prime's 3.7. And for most banks, that'd be their prime lending rate, and they have a lot of lending products based off of that. So if we go up to a bank rate around that 2 to 3 zone, you're talking another, what is that, another 2%, 2.5%, which takes your prime in that 5.5 to 6 zone. And that could happen within a year. So that could be still a steep increase. Is it the 19% of the 80s? No, we're nowhere near that. But when you're used to rates at 2 and suddenly you're getting prime near 6, that is a rather steep increase. And a few dates for folks. You mentioned the Bank of Canada. July 13th is their meeting. The Fed has a 2-day meeting, which concludes July 27th. So likely more increases in July. Both central banks take August off, so no increases in August. And then they're back at it in September. So I think July, likely we're going to see rates go higher. And probably September, you can see another increase. And then we'll have to see what the numbers look like from there. But July and September seem almost like a shoe-in for additional rate hikes.
Yeah, and again, I guess the other point is if you've raised rates a certain point and you do hit recession, what's one of the ways that you're going to start to re-stimulate the economy after it's gone down? Well, then you're going to start to see a rate reduction. And
Yeah.
so if you give yourself enough points to play with, you can come down by 25 basis points or by 50 or whatever else to stimulate that economy going forward. So they're playing into both points of this.
Yeah,
But
they're
yeah,
raising
I
rates so
think
they
you
can
will.
lower them later on. Like they're raising
Yeah,
them now, and
exactly.
then they'll lower them in, I don't know, maybe 2 years, whatever that time
Yeah.
period is. But they raise them today so they can lower them tomorrow. That's kind of the game they play. But shifting gears here a little bit, we got to talk
Yes.
about crypto because I know
Mhm.
when crypto was flying, go back to 2020, the talk was this is different. This is an inflation
Yes.
hedge. This is outside of the federal fiat currency, not impacted by central banks. Lo and behold, central banks start raising interest rates and it acts just like a tech stock. It acts like pretty much the overall NASDAQ. I'll pull up a chart here. We don't need to get too fancy, but we can explain. Just look at the lines. The blue line there is the NASDAQ. The black line is the Bitcoin relative to the US dollar. And then all the stuff down at the bottom here is just different correlation periods. The idea being
Yep.
not so correlated, 2020 onwards, actually quite correlated. It acts essentially like a tech stock, like a NASDAQ 100 security on the way up in 2020 and also on the way down here. It's not one for one, but a pretty tight correlation there on the way down. So maybe in the future it'll be inflation proof and act differently, but this time around it's act very much like a NASDAQ 100 tech stock.
Exactly. I mean, I heard the exact same speech I heard on this was back in 2000 before the tech wreck came, where, oh, it's a different world this time. Tech now runs thing. Old economy's never going to be around. Well, we saw that that was a falsehood and didn't last. And of course, Bitcoin was the new currency. It was going to dominate the way the world is. Well, I think most people are believing that, yeah, the US dollar isn't going anywhere. Fiat currencies are still going to be there. And Bitcoin, as you say, looks more like a tech stock, which is really where it's been. I mean, it's a technological currency, if you will, but it's still tech based. And as a result, I think that you're going to see these kind of correlations for a little while longer yet before they can break anything else out.
Yeah, and correlations can change. They can be cyclical.
Yep.
There's no guarantee that this is going to last forever, but it makes a little bit of sense. The whole Bitcoin,
Yep.
not just Bitcoin, the whole cryptocurrency universe and all the blockchain technology, have a lot of money pouring into there, a lot of new projects. Makes sense that it's kind of viewed in the same way an upstart tech company would be viewed and
Yep.
evaluated and trading in a similar manner. That makes a bit of sense. It's trading like a tech stock and it's trying to be a disruptive technology. So they kind of get lumped in together, which makes a bit of sense. But had to bring that up there, Kevin. And then, of course, we're going to shift. Got to be one of your favorite topics. You can see hockey
Yes.
there on the bottom, and so much to talk about. I got to start though. I gave you a loaded question last time about Colorado winning the Stanley Cup. Said how many games? You said 6, and you were bang on. You're bang on. They won the cup in 6 games.
I called over and I made sure that Bender, the coach of the Colorado Avalanche, didn't win at home. I mean, I know they would have liked to, but that would have really screwed up my parlay on my sports betting. So I needed the 6th game, as it were. So, yeah, it was nice to see. I mean, Tampa Bay had a 2-year run, almost going for 3, which would have been the first time since the Islanders back in the mid-'80s. Or early 80s, should I say, before they had that scenario. But at last, it was not meant to be. Maybe Colorado's into that scenario. On the other hockey topic, the biggest factor that's been going on in Winnipeg for the longest time has been hashtag Trotz Watch. And as we found out last week, Barry Trotz has decided this year he is not coaching. So unfortunately, he gave the Winnipeg Jets the news. And we now have to start our search again. But there's plenty of candidates that are already in the pool. The Rick Tockett's, the Andrew Brunettes, the Scott Arneals, as well as the Jim Montgomery. So I'm sure that within the next week or two, we'll have an announcement here to see what track the Jets look like they're going to be on coach-wise.
Yeah, I think Rick Tocchet would be an interesting choice, but we'll see. We'll see. I mean, it's not just a one-way street. We can't just pick who we want, right? There has to be a good fit there.
Yeah, and you're going to have somebody that's probably more defensive minded. It's going to be a different style than what Paul Maurice was running beforehand. And I keep thinking, wouldn't it be ironic if they hired Andrew Brunette, who was the coach in Florida, and Florida hires the coach that was in Winnipeg? That would be a really good topic to talk about for a while. We could see how that plays out. There'd be a duel there. But yeah, otherwise, it's going to be something different there. But enough with the hockey scenario. It's now finished for the year. We don't have to worry about it until basically October of next year. What have we gotten as a question today? Who has sent us? Which viewer really wants to know some stuff that we've done?
We've had this question a couple of times from a handful of folks, so it's worthwhile for us to address. It has to do with GICs. We know rates are going up. As they raise rates, that means GICs go up. And it kind of leads to the question, kind of how high do GICs have to go for them to start making an impact, right? When GIC rates start climbing, people go, oh, the market's volatile. I may actually get paid on my savings now. That's looking more attractive. What do you think that rate is where it starts to have a psychological impact?
Well, to me, I think that rate is basically the 5% rate. I mean, we've had GICs that haven't been anywhere near 5% for quite a while. And that seemed to be, I remember back when the whole tech wreck went on, that, when rates came down to about 2 or 3, you could get on a GIC. People would have backed up the mortgage and put it into a GIC if they got 5% then. Nowadays, I think we're still pretty much in that same boat. It's sort of that psychological area with the 5, 10, 15, 20 scenario, I think. So to me, 5% is the goal. If you can get 5% on a GIC for a relatively short frame of time, I think that's going to be the other factor. I don't know that everybody wants to lock in for 5% at 5 years, but if you're close to that on a 2-year or a 3-year, I think you're getting a lot more money that looks at these investments, or at least wants these investments going forward. What do you think?
Yeah, I think we're going to get there too. And I agree with
Yeah.
you. 5 is just like a round number. It's a psychological number. So you're above 5, like, is it 5.2, 5.3? I don't think that it makes that much of a difference, but I think above 5 is going to make a big difference. And I agree, it has to be on a shorter term. Like 5 on a 5-year is helpful. 5 on a 2-year looks far more attractive. And I think we're getting there. Like, you're already over 4 on a 1-year. You're pretty close to 4.5, 4.6 on a 2-year. That's already. And if we get the 2.5% increases we're talking about, not all of that might end up in a GIC, but a big chunk could. And you could easily be in a 5 to 6% GIC on say, like a 2-year time frame. I think that would be possible this time around. And I think that'd have an impact. That'd make a big impact for folks. And then that's what they want to do. That's how they slow down the economy. They increase the cost of debt. They make savings more attractive. Money kind of gets sapped out of the economy, and that slows everything down. So it's all kind of part and parcel with what they're working on there. Anything you wanted to add, Kevin?
No, and again, I mean, just on that rate scenario, we have seen this recently too, where, I mean, the high end of the curve, I mean, it's basically a flat curve. What you're getting now on that 1 to 2 year frame, you're not really getting much more on the 4 to 5. So you're right. These could be things that come up from there. But yeah, if you have any more questions and you want to know anything more about what we've talked about today, any of our other back and forths or financial 15s, please visit us, chatwithclintonandkevin.com. Give us your questions. We're more than happy to answer anything that you come across with. Hopefully, we'll provide you exactly the information you want. We can get that there for you whenever you have a chance. But otherwise, I think we've covered most topics today that we wanted to let you know about inflation, rates, and of course, most importantly, hockey.
End on a positive, of course. Take care, everyone. We'll see you again soon.